Welcome to this episode of the Investor Ready Funding Podcast. This week, I'm very pleased to welcome Marcus Love from Love Ventures, who's come to give us the investor's perspective of looking at what it takes to be investor ready. So Marcus, could you just give us a little bit about your kind of background and where you started and what you do now as an intro?
Sure. Well, thanks for having me on. And yeah, just a quick intro on myself. So 9 years in Paris, working in consultancy, primarily at Capgemini, but then also I went to work for a startup. And I moved back to Paris from Paris to London in 2005. I spent 14 years working in the city in independent equities research. And during that period, I started doing a lot of angel investing and built up a portfolio of around 20 investments. I created a syndicate of people that invested alongside me. And that really was the genesis for Love Ventures and how it all started.
Brilliant. So to dig into Love Ventures a bit more, tell us about what particularly made you decide to shape it in the way that you have. What made you decide on that particular investment thesis?
So through that angel investing and those 20 investments, we'd already zoomed in and honed in on our investment thesis. So we were investing in Fintech, Proptech and consumer tech as our three sectors. That's where we had the most interest. It's also where we added the most value, because we were helping these founders on their journey with contacts or with ideas for their business. And that's how we got involved in those sectors. And we also enjoyed working in that space, which is seed to Series A, and predominantly the last check before Series A. And that's because companies have got to a certain level. They still require a lot of help, but it's also the area we get really excited by. And so that's where we've been working. That's where we had the most interest. And it's also where people have been investing alongside us, and they backed us to say, why don't you go off and do a fund? We'll invest in the fund with you. And that's how it all started.
Sure. So much like many of the startups that you invest in, you kind of proved your traction, proved your capability first, and then grew that into something bigger. Cool. Okay. So obviously there's the thesis around the fintech and proptech and consumer tech. But in investment these days, there's huge emphasis on diversity and what impact that has on how businesses work, who you should invest in, who's getting investment and who isn't. What's the stance from Love Ventures on, what's your take basically on your approach to diversity, and what kind of matters most in terms of where you see it impacting?
Yeah, well, first of all, I think it's recognizing that there is an issue in VC around diversity. So first of all, it's to acknowledge that there's been an issue. Secondly, to decide how you're going to address it. There are dedicated funds that go out and invest specifically on a diversity angle, and that's fine, and they'll raise funds going towards that. And there are others that are just going to take it into their investment criteria in whatever form they decide to do. The way we've addressed it is to have a diverse scouting program to make sure that we're reaching parts that we might not otherwise be seeing, because we have our own networks that we've been using to source deals. But if you have a diverse scouting program and diversity within that group, that will already help source the deals that you might not be seeing. And then it's in your ability to then have those deals coming in and have whatever filter you apply on it. Now, for Fund 1, we haven't applied a diversity filter. We're not specifically looking to apply any filter. We have our investment thesis, and if someone is ticking another box, then that's fine, but we have our investment thesis. That said, because of the recognition that there's an issue and us wanting to do more, we are now trying to do something about it. So, for example, the scouts, when we meet, we used to bring in 1 or 2 founders to come and present. And we're now reaching out to those communities to make sure that they're able to come in and almost have like an open hour where we can then help them and say, look, you might not be at the minimum monthly threshold that we look at, but we can help you get there by giving you some advice. So in order to do that, we've also got our head of investor relations, who gets involved with a lot of female-founded businesses. She's part of various organizations and networks that will promote female-founded businesses, and that's the sort of thing that we're doing to address that diversity problem, because it is a problem.
Yeah, yeah, definitely. Okay, it's really interesting that you say that about the having diversity in the scouts, because on the converse side, when we're talking to startups about, you know, how they might inadvertently build bias into their own products and services, and we say to them, you know, if your development team, just by nature of who you've had to hire, is a group of 20 to 30-year-old white males, obviously there's a risk that you might build bias into the product, but you can counteract that by having a really diverse testing group that represent all the demographics that might use the product. And I guess your diverse scouting group is very much the same. So it doesn't necessarily matter who's at the center of the fund, as it were, because the scouts are very diverse and they're going out looking at it from a diverse perspective to make sure that they bring people in. So it's interesting to see that kind of parallel of widening your scope by making sure you've got diversity in the scout groups. So that's really interesting. Okay, so obviously we can't ignore the big C, the COVID pandemic. What's your view on how it's impacted investing so far, both at the stage that you invest at, but also at, you know, very early kind of pre-seed stage and later on?
It's really interesting, and I'll try and keep it sort of brief, and you can dig into some of the subjects we want to raise. But I guess initially there was shock, and the funding was a real issue, particularly for smaller companies. Large companies and listed companies went out and raised debt quite fast to make sure they covered their capital requirements, and smaller companies don't have that luxury. They're not listed, and the funds are a bit tighter. So I would say, let's call it March to June last year, there was that initial shock. But what then happened is that technology in particular, but also other areas like healthcare, benefited hugely from wider adoption of technology, or companies that were then thriving in the new environment. And we've benefited from that, actually, because we invest in technology-driven companies. So I mentioned the angel portfolio I have. I know that 10 out of 20 of those companies have just had their best month ever last month. So most of technology is doing pretty well. We don't invest in healthcare, but a lot of healthcare is doing very well as well. So it's been really interesting. And then moving forward from that June period, as it was clear that companies were potentially benefiting, I think the funding environment improved for a lot of those startups. It's still not where it should be, in my view. I think that some of the smaller companies are still being overlooked. I think funding is hard for a lot of companies, but if you've got a really good business, then in my view, funding should be okay, because there's low interest rates. The world seems to be awash with capital, and I think good ideas do find good funding.
Yeah, definitely. And when you look at some of the frightening valuations and raises that are coming particularly out of the US at the moment, it does seem like the world is totally awash with capital and people are just willing to throw it. So it's about being able to package up what you've got, your business, your idea, and you know, get it across to people as effectively as you can, I think. Okay, so in terms of, obviously we've talked about the impact of the pandemic, but are there other kind of current trends that you're seeing in startup investment, whether it is sector focused, raise amounts? Are there other things that are playing a part in market movement at the moment?
I think, well, you touched on the valuations, and that's one thing they've been edging up. And we do see kind of larger rounds. I mean, everyone's got a bit lost with the stages we're at, and sort of seed levels and Series A levels have become larger. Sometimes people are raising, you know, pre-revenue, etc. So I kind of feel like the rule book's been thrown out of the window a little bit. So then it depends on where you're investing and what you're doing. So if I look at fintech, for example, versus proptech, fintech in the UK is certainly a little bit more of a mature market. There was £3 billion invested into fintech in 2020, second only to the US. And it's certainly a bit further down the track than, say, PropTech. So what we see is fintech valuations are around 2 to 3 times what they are in PropTech for that reason. But again, we're way behind the US. Our fintech valuations are about 1/3 of where they are in the US. So you could argue they got further to go, and what we have is reasonably sensible. You could say the whole world is slightly overvalued, and therefore they're all a bit high. But what I would say, as I said, is that the rule bit's kind of gone out of the window, and I don't really go into anything with a filter or judgment, to be honest, anymore.
Yeah, it's definitely. I mean, I saw last week something like a pre-seed that had raised at 10 million, and then you see someone else going out for late seed who's trying to just raise 500k, and you're sort of, hang on a minute, what's going on? It's all over the place. There are no clear definitions, like you say.
It is crazy. What I would add, though, is from my time in the city and looking at growth equities, is that you do have to pay up for good quality. So valuations can be potentially justified depending on what you're going into. You know, if that company you just mentioned seems like a high valuation, but it's the next Klarna or the next Revolut, it could be the deal of the century. So that's the VC's job to evaluate and decide. And sometimes it's worth paying up for that, and therefore you will pay it.
Yeah, definitely. And I think the times when you see those highest valuations often seems to be when they are previous entrepreneurs with strong experience. They've closed out, they've exited successfully from something else, and now they're coming back for another bite of the cherry, and therefore there's a lot of willingness to invest in their expertise, so they can command those higher valuations at a much earlier stage than someone who's just starting out and has never done this before.
Absolutely. And it's something we look at very closely at Love Ventures, is founder market fit. We like to invest in founders who know their sector, they've been there and done it. Often they're exited founders, so they've actually got that ability to take a business, to find their product market fit, get the go-to-market strategy right, to scale it, which is hard as well to execute. You might have a great idea, but you need to be able to go and deliver on that, and then execute, and then scale it, and then exit. So there's so many things going on. It's really tough, the sort of the whole route for an entrepreneur. But we look for founders who've been there and done it, and most of our portfolio has got exited founders in there.
Yeah, definitely. Okay. That's definitely an interesting area to me, because having the idea doesn't mean you can run the company. Running the company doesn't mean you can grow the company. Growing the company doesn't mean you can exit the company. And there's a whole, I think there's a whole thing potentially that founders can neglect in terms of their own personal development, their own capability to lead through all those stages. And if they're just focused on the company and the data and everything else, thinking about what they need to do to grow as a person through those stages can get lost. But it's super important, because otherwise they can become not the best person to support that business, and investors can look for another leader.
Well, it's a different skill set that's required, and you sometimes see founders moving on saying, look, I was the right person to come to a team of 50 or 100 people and to grow that, but I'm not the right person for the next stage. That's quite often the case. Or they surround themselves with different advisors or people with different skill sets. And that's the other thing I think that COVID has really promoted, is that a lot of people don't go into a job for life anymore. When we were at university, you probably remember the milk rounds, and there would be BP or Shell or Glaxo, and people would join these companies. They'd go into a stable job and a graduate program, potentially for a long period, 5, 10, 20, 30 years, with a pension and all these things. What you find today is a lot of people are self-employed. There are 3.5 million self-employed people in the UK. They often have more than one client or more than one side hustle. And I think in the tech world in particular, I think it's very interesting, because you can bring in that talent to your business, and it doesn't have to be someone who's permanently employed, and they can help you on that particular journey. So, for example, getting from seed up to Series A, that might require different skill set in terms of growth marketing and all these things. Getting from Series C to Series D is probably going into different countries or into different markets. That's a different skill set. And so, absolutely, then these companies can evolve. And as long as they're aware that that can move, that's the main thing.
Yeah, definitely. It's the you don't have to do it all or know it all. You have to get the right support. Okay. So let's dig into what makes an investment approach something that you want to engage with. So you said, good propositions find good funding, but what's the kind of thing that really kind of turns the pulse rate up a bit when you start reading the deck and go, hang on a minute, this looks like something we really want to be involved with?
Yeah, as well as it's exactly that. First of all, you get really excited. I mean, most investments I've made, I've known pretty quickly, so in the first 2 minutes, that you're keen to make that investment. And it's normally something you've seen in the deck or in the idea, and you go, that's a great idea. And straight away you're thinking, why has no one done it before? Or how can they develop that idea, etc. But great ideas don't always end up being great businesses. So then you've got to see the rest of the deck and how it's going to go forward. And that's the other thing about that funding gap from seed to Series A. There are great ideas that actually never see the light of day or don't get properly executed, lots of them. And there are also good ideas that get funded that probably never should have been funded. I put some of those in that bracket of companies that may have suffered between March and June last year. Positive note of COVID, it may have ended the prospects for some companies which frankly probably weren't the right things to be doing or needed to change. So I think around 70 or 80% of startups pivoted in some way, shape or form in the last 12 months. And that's really important as well. The ability to be agile and to change and to adjust according to what we're seeing. You take your sails, adjust it according to the wind, and that's been going on a lot. But yeah, back to what we look for. We certainly want to get excited, and like I said, it's in those first few pages of the deck. You normally see something new, and we look for category creators, people who are doing something completely new in their sector, and there's a huge amount of opportunity out there. Again, if I go back to fintech, and there's wealth, robo-advisors, there's pensions, there's just savings, there's just a ton of areas which can still be disrupted enormously. And where we are in the UK is really at the forefront of that, with things like open banking, which are promoting a lot of innovation. And that was the UK's forward-thinking implementation of PSD2 legislation.
Yeah, okay. So flipping to the other side of the coin, what drives an immediate no from you when you start going in that first 2 minutes of going through a pitch deck? What's oh God, no, I'm not going near that one.
It's a really tricky one. I try not to show any sort of any reveal too much, certainly to start with. I mean, these founders have worked really hard. This is their project, their baby, and you have to be respectful of that. They both put a lot of their own money in, and maybe it needs tweaking to get to the next stage. So I always try and offer advice. I've genuinely tried to say, look, maybe you should do this, or not even go any further where appropriate. So I think the first thing is to be respectful. And then in terms of flags, it's tricky. I sort of smile when I see these charts with this huge hockey stick growth, and we're going to get to there in 5 years' time, and they basically haven't got any revenue. They haven't even decided what they're doing. I don't even see a team page in the deck. So yeah, there's a few things which are sort of turn-offs, if you like.
Yeah, so again, I guess it comes back to that the point you made earlier about it could be a great idea, but if it's not showing that it's a business as well as a great idea, then that's when it starts to kind of look unattractive.
Yeah, and if it's in between, so there's an idea and there's something, it can be, look, hey, why don't you go back and tweak this again, or we can follow this, get this part right, and we could be interested. So for every investment we've made, there's lots that we haven't made, but there's quite a few in there that we're tracking, or that we could have made had something else been slightly better. And we've just closed and pretty much deployed our first fund. We're working hard on a second fund, and there are plenty of companies we've been talking to that we can go back and see how they're doing for fund 2 or even fund 3 and beyond. So we engage with the founder community. We know what they're doing. We watch them as they pivot or as they evolve. If we miss rounds because the timing isn't quite right, that's fine. There's still going to be other rounds. These are growth companies that require funding probably every 18 to 24 months at a minimum. So they're going to require new investment, and there's always going to be an opportunity to go back and engage with those companies.
Yeah, super. Okay, so let's get into the kind of the real nitty gritty of preparing for raising investment. So when a founder or founders engage with you initially, what do you prefer? What's your preference for documentation that they might share first? Is it a one-pager? Is it a 15-slide deck, a 3 to 5 page investment memorandum? There's so many different things that people say, oh, we always ask for that. So
there are lots of ways of doing it, but our preference is for a deck. Normally, 14 to 20 pages. Two of the businesses we invest into had just 13, 14 pages. And from the founder's perspective, that deck is the initiation, and the call to action is then to get a meeting. You're not trying to divulge everything about your business just in the deck. The financials could be one page or even high level. They don't have to be within the deck. So for us, it is a deck. It's high level. It's the engagement to get us to the next stage, which is that meeting. And again, there's no shame in not having a match. It's not necessarily going to be right for every investor or VC. We turn lots down just because it's off thesis. Doesn't mean to say it's not an interesting business. I mentioned healthcare earlier in the call, and I think healthcare is fascinating. It's just not an area that our fund is investing into. And so we have that filter because we have a duty to our investors to only invest in those sectors, and we can't stray from that. So my advice to people would be, check out what the VC or the investor looks for in the first place. Try and do your homework. It's just like going to, say, a job interview. You would never go to a job interview without knowing about the company, a little bit about the team, the person you're meeting, the sector, and what they're doing. The VC is the same thing. And I get a lot of decks that come in that show me they haven't either done their homework or just not appropriate for what we do. And that does sort of say to me straight away, okay, they haven't really worked hard enough in the first place. So get over that first hurdle, find out what the best way is to approach them. And as I'm live now and people might be listening to this, then at least you know how to get to me. It's a deck. We will always look at a deck. We have a very good deck review process. We involve our scouts in that process. We review 20 or 30 decks a week when we're in full deployment mode. And we always look at decks and give feedback where appropriate.
Brilliant. And I think that, that point around doing your research first, it is a vital one. And it's something I wrote an article on the other week because it feels like actually there's an opportunity for founders to help each other out, because at the moment, VCs like yourself are going through 20, 30, 50 decks a week, and then probably trimming at least half, if not 3/4 of those out because they don't fit thesis. Well, if everyone actually did their research and only applied to the VCs that fit, the thesis fits, actually there'd be a much smaller number of suitable investment opportunities to really look at, and it would help them stand out from the crowd better, because it wouldn't be like 1 of 50, it would be 1 of 5. So I think there's a real kind of responsibility on founders to try and do that research up front and help each other by not randomly sending decks to people that it's not relevant for.
Yeah, absolutely. And definitely in terms of being part of a community, we've always felt part of that founder community. We've founded businesses ourselves. We want to see founders help each other, and as we emerge from COVID, physical events are going to come back. I got very, very involved in this world originally because I was going to crowdfunding events with Crowdcube and Seeders. That's the opportunity to meet with founders, to see them in live and to ask them questions, but also an exchange of advice or founders talking to each other. And there's plenty of opportunities to do that. So we've got into this sort of COVID world of pitching online and short pitches, and that's fine. I think that's always going to exist, but there's also a world that we're going to go back to, which is seeing people face to face and networking. And founders do network. Lots of founders I know help other founders. We want to be part of that. We want to promote that ecosystem.
Super. Okay. So in terms of valuations, we touched on them a couple of times. What are the challenges for you when evaluating, a valuation that a startup's put forward when they come and say, oh, we're putting forward that we've got a valuation of 5 million and what's your kind of I guess mental process for, is that the right valuation, and how often are you having to challenge valuations that you think are inaccurate?
Yeah, so this is, well, it's a big topic. First of all, most companies, when you go into advanced due diligence, will open up a data room and they will share their financial projections. And we've seen more basic ones as well as more developed ones. In the more developed ones, they often have scenarios as well, where you can type in bear case, bull case, etc. for the more advanced companies. That's a real help, because you want to be able to see how things are going to go. If things go badly, what could go right? I mean, if things go really well, what does that look like? That gets VCs really excited. It's nice to be able to play around with that in an Excel file. So I would invite any founders to bring people in with modeling skills, and again, they can bring that skill from externally, and we look at that, but also we'll look at their modeling. We'll probably apply our own modeling over and to the top of it, and you probably know there's various valuation styles and models you can use. Like, you can use a mark to market, you can use a peer group analysis, you can look at cash flow analysis. So we apply a variety of those things. And although my background was in the city and I looked at this a lot myself, I wanted to make sure during COVID that I was benefiting from the things that were available. So in early 2020, I did a course at the LSE specifically on valuations to make sure I was up to speed with the latest techniques, and making sure that I was able to do cash flow analysis effectively myself. And a lot of our scouts and analysts that we employ at Love Ventures are CFA level charter holders, most of them at least level 2, some level 3. So they're frankly probably more qualified than I am, but they help a lot. And when you get more than 1 or 2 pairs of eyes onto these valuations, things stand out. So it's a little bit crazy, you just call it out. Back to the earlier point, you might have a great business and a great strategy, and yes, you might be very investable, but if the valuation turns out to be crazy, then it might not happen as well. So lots of boxes have to be ticked to get that investment, which is why it's so tough. But valuation is just one of those boxes, and as I said, it might be worth paying higher valuations for the really true stars of tomorrow.
Yeah, definitely. Okay, so let's move from paperwork to people. So first meeting with an entrepreneur. So maybe they've sent you their deck, you've got excited by it, sounds good, and that gets them their first meeting with you. What are you hoping for, and what's the kinds of things that makes that the last meeting that you'll have with them?
We look for a number of criteria in our investment thesis, but this will resonate with other investors out there. We look for that founder market fit, which I mentioned. We want to look for the company which has a right path to profitability, and the business model that's going to enable them to do that. So we're going to test those metrics around CAC and LTV to make sure that they're feeding in the right metrics, and it's realistic that they can get to that point, but also that they can be revenue generating. So we don't invest in businesses that have less than £10,000 a month of revenue. And companies might not be there yet, but on their way, which is why we track them. But the companies that we invest into have to have £10,000 a month minimum monthly revenue. So again, we just don't invest in companies that don't have that. We look for companies that are scalable and that have technology at the core of what they do, because we're technology investors ourselves. And we want to see if they've got any protection around that technology, and we want to see network effects. So when their users come in and use their products, they get better and better with each iteration. So it's something that Facebook, Amazon, and Google have done on a sort of mass scale. But at a small startup level, we know as these companies grow, all the new users coming in help feed the machine and make it better and better. But they also make it better for the individual user. We all know when we use an app or a service, it gets to know you, and it gets better and better as it progresses. And then also we want to be able to help that company. We have a team of advisors, and we want to be able to help and assist that company grow through that seed stage and then up to Series A. And I guess for them, the next step is to get that second meeting. If I've met with a company, I want to see other team members meet with the company. If my brother Adrian, who's co-founder and general partner with me, has met with a company, then he'll want me to meet with them. So they've met with both the partners. And then we have a team of advisors. They go through a process where at least 2 of our advisors will meet with that company. And we also put in expertise as well. So in our first fund, we had around 50 investors. A lot of them are very engaged with us and have their own skill set and want to be able to assist us. So we bring in other expertise to meetings to validate when we don't have necessarily that sort of skill set ourselves. And that's very important, because you might be talking about mortgage financing or something like this, and you bring in a mortgage specialist who's really going to know what they're talking about. That also is of use to the startup. They might be able to bounce ideas off the specialist as well. So that's how we progress. And yes, we are ticking boxes in our mind over those things that I mentioned, because companies need to fit that. And the aim for companies that meet with us is to get to that next stage, which would be a follow-up meeting. And in the follow-up meeting, we're probably going to dive a bit deeper into their product. We might meet a product manager and have a demo and see what their product does. We'd probably meet with someone who's a bit more technical as well, or certainly other team members. And when we invest into companies, we often invest into businesses that have co-founders, those 2 people. If we've got the first meeting with one person, then the second person we'd invite to the other meeting. So we see more of the team.
Great. Okay. So once you get past that kind of first couple of meetings, where do you go next? You've had a couple of discussions now, you've got a really good sense of the product, of the founders. It still looks like an interesting proposition. What's your next step from there?
We want to move through our process. So there'll be a second advisor meeting. So you're probably into meeting 3 or 4 by this stage. But if we validated a lot of the things that we look for, we will write an investment memo internally, and we bring that to our investment committee. And then we have an internal debate about whether we should or shouldn't invest in that company.
Brilliant. Okay. And then after that, if the investment committee says yes, it goes to due diligence and term sheets and
DD. We sometimes at investment committee will have the authorization to then go to the next step, which might be to delve in a bit deeper. So let's say there's a startup where things are moving very quickly for them and they're trying to close a round. We might want to accelerate things on our end. So it looks pretty good on the surface. We tick lots of boxes. We've done 2 or 3 meetings. We go to an investment committee where we might be missing 1 or 2 things, maybe on the legals or the financials, which we're going to validate. But subject to those things being validated, we would make the investment. So we can go back to the company and carry on, because once you get into term sheets and DD, that process can take a while. It depends really on them. On us, it depends on our advisors, both tax and legal advisors, but we can move very fast. We pride ourselves on being able to write a check within 2 weeks if we want to, and we have done that. But we do have deals sometimes that take up to a month or longer to do, because maybe the intricacies of the legals take a bit more time than we would expect.
Yeah, sure. That's still really quick compared to a lot of them out there. So
it's really quick. I mean, Fund 1, we closed in December. We've written 6 checks already. We're about to write the other 2. So we would have fully deployed our first fund in around 6 months. So that is the model that we've employed. We are moving fast. It's also because those companies are moving fast. They don't want to be eternally fundraising. They want to raise their funds, go off until they get to the next level. We want to help them get to the next level. And therefore, if we can move fast through that DD, that's important. And we pride ourselves on that. We feel like we're new kids on the block and we're able to do that. And back to the COVID point, we're able to do that faster. In the old days, if you're traveling to meet someone for that second or third meeting, that process could have been dragged out over a number of weeks or even months. We're able to move very fast now because we can do those interviews, we can do the DD effectively. Companies are much better with their data rooms now, and it's all secure and able to be shared with the right people at the right time. And our friends, the lawyers, are even moving faster than they ever have because they're at home, they've probably got fewer distractions. They also are implementing technology like DocuSign and other products to be able to move fast. In the old days, companies would have to send documents potentially around 30 shareholders.
Yeah, couriered for wet signature by each person.
Couriered around from one place to another. And it just, frankly, it seems a bit crazy when you think about it now. So we're able to move fast, but we're not the only ones. Everyone's embracing this as well. And I think it's great for the ecosystem. Because, as I said, founders probably enjoy fundraising, but some don't. And they certainly don't want it dragging on and detracting from their business.
Yeah, I think it's super important that the fund givers, if you like, can keep pace with the companies that they want to fund, because otherwise it does almost create a lag effect for UK-based startups or startups raising from UK funds. So I think that's a really interesting development that I hope we'll see a lot more of over the next year, particularly now that people are, like you say, much more comfortable with the tech and realizing how they can streamline their own internal processes to be that bit quicker, to, you know, to be able to embrace it in that way. So I think we'll start to see a lot quicker rounds, hopefully on a lot more sectors as well.
Yeah, absolutely. And then even the ability to actually impose things now has happened. So if I look at our first fund, I think we were told that we could have, you know, written application forms, and we're like, no, we're a technology fund. Everything is online. We're not going to accept written application forms. So it was just like a no from the off. And you're able to do that now. I'm sure pre-COVID it would have been, well, you need to be able to accept written application forms, but we just don't. It's all online. It's probably how it should be to make it smoother and simpler, and it means you can scale and you can move quickly as well, which is very important.
Definitely. Okay, so one final question before we finish today. So what's one thing that you would love all founders to do when they're preparing to raise investment?
Oh, it's a great question. I mean, do your homework on the other person first, because you're going to save yourself time if you know a little bit about their thesis and what they're doing. And the second thing, so I'm going to do 2 points, is to manage the time, because if the slot's 1 hour, you really want to get into the nitty gritty fairly quickly. So as I said earlier, I think it's 2 minutes for me to make a decision, and I want to get into the nitty gritty over the next 15. So by 15 minutes in, you've covered a lot. I sometimes see founders who are reading through a deck and get to page 5 after half an hour. And it's not appropriate. If they sent a deck, that means you've seen the deck already. So manage the time effectively once you've got to that first meeting stage. Control the meeting. Make sure you're checking in. Do you have any questions? Where have we got to in terms of the time, and are we good? And judge by their reaction. You know, you're opposite someone, see if they're engaged. And for me, that's all part of that process. And I think founders can improve on that. So they can learn and get better. It's not always going to work. Not everyone they see is going to invest in them, but they can certainly listen, learn, adapt with each meeting that they do. But yeah, do your homework and manage your time.
Brilliant. Thanks, Marcus. Really appreciate all your insights today.
Thanks for having me, Judy. It's been a pleasure.
No problem.
Bye.